The date is December 31st, 2025. While the rest of the world is preparing for celebrations, the silver market is witnessing a silent execution. If you looked at your screen this morning, you saw a cliff, a vertical drop that erased weeks of hard-earned gains in a matter of minutes. The headlines will tell you that investors lost confidence. They will tell you that the silver rally has finally run out of steam, but they are lying to you. Silver did not fall because the world suddenly stopped needing it. Silver did not fall because a new mountain of supply was discovered in the Andes. Silver fell because the invisible architecture of the market was rewired overnight. Welcome to the world of the CME Group, the masters of the exchange. While you were sleeping, a single memorandum was issued. It was a margin hike. To the average person, that sounds like a boring administrative detail. To a professional trader, it is a death warrant. This morning, the cost of holding a silver position was artificially increased. Thousands of traders who were long on silver woke up to a reality where their collateral was no longer enough. They were not given a choice. They were not given a time to negotiate. Their brokers simply pressed a button. In the next 30 minutes, we are going to deconstruct the mechanics of this collapse. We are going to look past the red candles on the chart and examine the actual gears of the financial system. You will learn why the paper price of silver is often a lie, and why the institutions use margin as a weapon to protect their own interests. We are going to travel back to 1980 and 2011 to show you that this is not a random event. It is a repeatable, calculated strategy. By the end of this breakdown, you will understand why a price drop caused by margin is actually one of the most bullish signals for those who hold the physical metal. The amateurs are panicking right now. The professionals are watching the inventory levels. Let us go straight to the trigger and find out what actually happened when the rules changed. To understand why silver just collapsed, you must understand the engine of the futures market. Most people think buying silver on an exchange is like buying a loaf of bread. You pay the price and you own the item. But the futures market is not a grocery store. It is a high-stakes arena of leverage. When you buy one contract of silver, you are controlling 5,000 ounces of the metal. At $30 an ounce, that contract is worth $150,000. However, the exchange does not ask you for $150,000. They only ask for a performance bond, known as margin. There are two critical numbers you must know. The first is the initial margin. This is the entry fee. Usually, it is a small fraction, perhaps $10,000, to control that $150,000 position. This gives you 15-to-1 leverage. The second number is the maintenance margin. This is the minimum amount of cash that must remain in your account as the price fluctuates. If the silver price drops even a little, your account balance falls. If it falls below that maintenance level, the trap snaps shut. This is where the CME Group exerts its power. They have the authority to raise these margin requirements at any moment they deem the market is too volatile. Imagine you are driving a car, and suddenly the bank calls to say your down payment has doubled, and you must pay the difference in the next 10 minutes, or they will repossess the vehicle while you are still driving it. That is exactly what happened this morning. The exchange raised the initial and maintenance margin by a significant percentage. Suddenly, a trader who was perfectly safe yesterday is now thousands of dollars short today. When the exchange raises the margin, it creates an immediate vacuum of liquidity. Thousands of accounts are hit simultaneously. This is not a voluntary exit. This is a forced evacuation. If you cannot wire fresh cash to your broker within minutes, the software takes over. The system does not care about your long-term thesis on silver. It does not care that a supply deficit is looming. It only cares about the math of the collateral. The broker must protect themselves, so they dump your position into the market at whatever price is available. When everyone is forced to sell at the same time, the price does not just slide, it craters. This is the mechanical reality of the silver market. It is a system built on credit, and when the masters of the exchange tighten the cord, the leveraged hands are the first to be cut. When the margin hike is announced, the human element of trading disappears. We enter the realm of the ghost in the machine. Forced liquidation is not a strategic decision made by a fund manager in a suit. It is an algorithmic execution. In a normal market, buyers and sellers negotiate a price based on their perception of value. But during a liquidation event, value is irrelevant. The only thing that matters is the exit. As the price begins to slip due to the initial wave of margin calls, it starts to trigger a secondary layer of destruction, the stop-loss orders. Most traders place these orders to protect their capital, telling the computer to sell if silver hits a certain price, for example, $29. When the forced selling from margin calls pushes the price down to $29, thousands of stop-loss orders become market sell orders instantly. This creates a massive surge in sell volume without any matching buy orders. Now, consider the timing. The exchange often implements these changes during periods of thin liquidity. If this happens during a holiday stretch or in the early hours before the major physical markets open, there are fewer buyers waiting to catch the falling knife. In a thin market, a $100 million sell order might move the price 10 times further than it would during a busy session. This is the cascade effect. Price drops, which triggers more margin calls, which triggers more stop losses, which pushes the price even lower. It is a self-feeding spiral of liquidation. The most important thing to realize is that during this panic, the sell button is being pressed by necessity, not conviction. The people selling at the bottom of the crash are often the ones who believe in silver the most, but they have been over-leveraged. They are forced to hand over their positions to the very institutions that triggered the event. This is not price discovery. This is a wealth transfer. The screen shows a collapse, but in the warehouses, not a single ounce of silver has moved. Only the paper claims are being shredded. The market is being purged of weak hands, leaving only those with the deep pockets to buy the blood in the streets. To see the future, we must look at the shadows of the past. The most famous example of a margin hike being used as a tactical weapon occurred in 1980. This was the era of the Hunt brothers, Nelson Bunker and William Herbert. They were billionaires who believed that the United States dollar was dying and that silver was the only true refuge. They did not just buy a few coins. They began to buy every ounce of silver they could find, both in physical form and through futures contracts. By early 1980, the price of silver had exploded from $6 to nearly $50 an ounce. The Hunt brothers were on the verge of cornering the entire market. The big banks and the COMEX exchange were in a state of absolute panic. If the Hunts demanded delivery of all their silver, the exchange would have defaulted because the silver simply was not there. So, the masters of the exchange did not try to outbid the Hunts. They simply changed the rules of the game. On January 23, 1980, the exchange implemented what became known as Silver Rule 7. This rule stated that investors could no longer open new buy positions. They could only sell. Imagine a sports game where one team is suddenly told they are not allowed to score points anymore, only the other team can. At the same time, the exchange hiked margin requirements to astronomical levels. The Hunt brothers, despite their billions, were suddenly faced with margin calls in the hundreds of millions of dollars. They could not provide the cash fast enough. The result was a total collapse. Silver fell from nearly $50 to below $11 in just a few weeks. The Hunt brothers were wiped out and eventually forced into bankruptcy. The narrative in the newspapers was that the greedy speculators had been defeated. But the reality was that the exchange had used administrative power to protect the shorts and crush the longs. This event established the blueprint for how the silver market is managed. When the price moves too high, too fast, and threatens the systemic stability of the banks, the margin hike is the first lever they pull. It is a lesson that every silver investor must learn. You are not just trading a metal, you are trading against the house. And the house can change the rules whenever they are losing. If 1980 feels like ancient history, we only need to look back to the spring of 2011 to see the same play being performed with surgical precision. After the global financial crisis, silver began a massive bull run. Investors were fleeing the devaluing dollar, and by April 2011, silver was once again approaching the $50 mark. The momentum was unstoppable. The physical demand was soaring, and the sentiment was electric. But just like in 1980, the price was rising too fast for the comfort of the centralized clearinghouses. What happened next was a masterclass in market intervention. In a span of just 8 business days, the CME Group raised the margin requirements for silver 5 separate times. Think about the psychological and financial pressure that puts on a trader. Each time the price tried to stabilize, a new memorandum was released, demanding more cash. By the end of that week, the cost to hold a silver contract had increased by 84%. The impact was devastating. Silver dropped from $49.50 to $34 in a matter of days. This was not a slow decline caused by a change in industrial demand or a surplus of mining. It was a manufactured liquidation. The volume of paper ounces traded during that week was many times greater than the total amount of silver held in the exchange vaults. The message to the market was clear. If you try to drive the price too high, we will make it too expensive for you to stay in the game. The data from 2011 shows a critical pattern. While the paper price on the COMEX was crashing, the premiums for physical silver coins and bars at local dealers actually stayed high or even increased. People were lining up to buy the physical metal at the very moment the screen was telling them it was worthless. This decoupling is the ultimate proof of the margin weapon. It is designed to break the momentum of the paper market, even when the physical world is screaming for more metal. When you see multiple margin hikes in a short window, you are not looking at a market correction. You are looking at a tactical strike. To navigate this market, you must accept a startling truth. There are 2 silver markets operating at the same time. The first is the physical market, where real industrial users, jewelers, and investors exchange hard metal for currency. The second is the paper market, where traders exchange promises. This paper market, primarily the COMEX, is where the screen price is determined. But here is the catch. There are often over 100 paper claims for every single ounce of physical silver sitting in a registered vault. This leverage is what makes silver so volatile. When you see a margin hike trigger a sell-off, you are seeing the destruction of these paper claims. It is a world of digital contracts, not silver bars. In the physical world, silver is a tangible commodity with a finite supply. It takes years to permit a mine and months to refine a bar. But in the paper world, a bank can create a short position representing millions of ounces with the click of a mouse. When the margin hike forces liquidation, it is the paper price that collapses. This creates a fascinating and often profitable distortion. During these crashes, you will often notice that you cannot buy a physical silver eagle or a 10-ounce bar at the screen price. If the screen says silver is $25, the local dealer might still be asking for $30. This gap is known as the premium. The premium is the real world's way of rejecting the paper price. If the physical market is tight, dealers will not lower their prices just because a margin hike forced some hedge funds to sell their digital contracts. This is why we say the paper price is a lie during a margin event. The institutions use the paper market to move the needle, but they cannot manufacture more physical atoms. As long as the physical demand remains strong, the paper price is like a rubber band being pulled away from reality. Eventually, it must snap back. Understanding this decoupling is the difference between a panicked amateur and a strategic accumulator. While the paper market is obsessed with margin requirements and collateral, the physical world is obsessed with conductivity. Silver is the most electrically conductive metal on Earth. It is not just a store of value or a speculative asset. It is a strategic industrial input that the modern world cannot live without. This is the industrial backbone that provides a hard floor for silver, no matter what happens on the COMEX. The primary driver of today's silver demand is the green energy revolution, specifically the solar industry. Silver paste is used in almost every solar cell to conduct the electricity generated by sunlight. In 2024 and 2025, the solar sector has consumed record amounts of silver. As we move toward more efficient cell designs like TOPCon and HJT, the amount of silver required per cell is actually increasing, not decreasing. Solar manufacturers do not care about margin calls at the CME. They care about securing enough physical ounces to keep their factory lines running. Then we have the automotive sector. An internal combustion engine car uses about 20 grams of silver. A hybrid uses about 30 grams. A full battery electric vehicle can use up to 50 grams. Silver is used in everything from power electronics and battery management systems to the tiny sensors that enable autonomous driving. As the global fleet transitions to electric, the demand for silver becomes inelastic. You cannot build a high-performance electric vehicle without it. Beyond energy, we are seeing a massive surge in demand from data centers and the hardware required for artificial intelligence. Silver is essential for high-speed connectors and switches that require absolute reliability. When you add up solar, electric vehicles, and electronics, industrial demand now accounts for more than half of the total global silver fabrication. This is the fundamental disconnect. A margin hike can force a trader to sell their paper contract, but it does not tell a solar company to stop building panels. It does not tell a car company to stop building EVs. We are in a structural supply deficit where the world is consuming more silver than the mines are producing. When the paper price drops due to a rule change, it actually creates a dangerous situation for industrial users. They see the lower price as an opportunity to stockpile, which further drains the already low physical inventories. The industrial backbone is the ultimate judge of silver's value, and that judge is currently shouting that we are running out. Silver does not exist in a vacuum. It is a product of geography and complex global logistics. When we see a margin hike in Chicago or New York, it is easy to forget that the metal itself is being pulled from deep underground in places like Mexico, Peru, and China. These three nations produce about half of the world's silver. However, the supply side of the equation is far more fragile than the paper markets suggest. The first major issue is that most silver is not mined directly. Approximately 70% of global silver production is a byproduct of mining for other metals like copper, lead, and zinc. This means that even if the price of silver doubles, miners cannot simply flip a switch to produce more. They would have to increase their copper or lead production, which is governed by entirely different market dynamics. This makes the silver supply incredibly inelastic. It cannot respond quickly to a price spike or a supply crunch. Furthermore, we are witnessing a massive geopolitical shift in where the physical silver is flowing. For decades, the West was the center of the silver world. But today, the East is hungry. China and India have become the dominant physical accumulators. China is not only the third largest producer, but it is also a massive importer to feed its solar and electronics industries. India, on the other hand, has seen record-breaking silver imports in 2024 and 2025 as its population views silver as both a luxury and a vital hedge against inflation. When physical silver moves from Western vaults like the COMEX or the LBMA to Eastern hubs like the Shanghai Gold Exchange, it often stays there. It is converted into industrial components or stored in private hoards. It does not come back to satisfy the paper promises made in the United States. This creates a geographic tension. While the CME can raise margins to push the paper price down in the West, they have no control over the physical bid in the East. If the price on the screen in New York becomes too disconnected from the price in Shanghai, arbitrageurs will buy the cheap paper in the West, demand physical delivery, and ship it to the East where the real value is recognized. This drain on Western inventories is the ticking time bomb that no margin hike can truly diffuse. In the world of high finance, there are no accidents, only incentives. When a margin hike triggers a massive sell-off, we must ask the oldest question in forensics. Cui bono? Who benefits? To find the answer, we have to look at the large commercial banks and institutional players who often hold massive short positions on silver. For these entities, a rapidly rising silver price is not just an inconvenience. It is a systemic threat to their balance sheets. When silver surges toward $50, these short sellers are under immense pressure. They owe millions of ounces of silver that they do not physically possess. If the price keeps climbing, their losses become theoretical infinity. A margin hike serves as a pressure valve. By forcing the leveraged long positions to liquidate, the exchange creates a sudden, artificial wave of selling. This stops the upward momentum and, more importantly, provides a window for the big shorts to cover their positions at a much lower price. The second group that benefits are the deep-pocketed accumulators. These are the sovereign wealth funds, the central banks, and the industrial giants who have the cash to buy without using leverage. They watch the screen during a margin crash with a very different perspective. While the retail trader is getting a margin call, the institutional buyer is placing limit orders at the bottom of the cliff. They are happy to let the paper market panic because it allows them to acquire physical metal or long-term contracts at a massive discount. This is the psychological warfare of the silver market. The crash is designed to make you believe that the metal is losing value, when in reality, it is simply being transferred from weak, leveraged hands to strong, cash-rich hands. Notice the language used in the financial media immediately after a margin event. They use words like bubble, collapse, and overbought. This narrative is intended to discourage you from looking at the fundamentals. They want you to focus on the price on the screen, not the inventory in the vaults. By understanding who benefits from the fear, you can stop being a victim of the volatility and start recognizing it as a gift from the very institutions that are trying to shake you out. As we move into 2026, the lessons of this margin flush must become part of your permanent trading DNA. The event we witnessed today was not a failure of silver. It was a failure of leverage. To survive and thrive in this market, you need a playbook that ignores the noise and focuses on the signals that actually matter. There are 4 key indicators you must watch every week to see through the paper smoke screen. First, watch the physical premiums. If the screen price is dropping but the cost to buy a physical bar remains high, the market is telling you that the metal is still in high demand. Second, monitor the inventory levels at the major exchanges. If the registered silver stocks are declining while the price is falling, you are seeing a massive divergence that always leads to a violent upward correction. Third, look at delivery behavior. When more traders stop rolling their contracts and start demanding the actual physical metal, the paper game is coming to an end. And fourth, watch global price alignment. If Shanghai is trading silver at a significant premium to New York, the metal will move toward the higher price, regardless of what the CME does. The most important takeaway is how you manage your own risk. If you are trading silver with high leverage, you are not an investor, you are a gambler playing in a casino where the house can change the rules at any moment. The only way to win against a margin hike is to have slack in your account. You must assume that margins will double when it hurts the most. If you cannot survive a 50% spike in collateral requirements, you should not be in that position. Better yet, holding physical silver or fully paid unleveraged positions removes the threat of the margin weapon entirely. In conclusion, do not let a red candle on a screen rewrite the story of a global supply deficit. The solar panels still need silver. The electric vehicles still need silver. The data centers still need silver. A margin hike changes the collateral rules, but it cannot create silver out of thin air. Today's drop was a purge of the weak, a gift to the strong, and a reminder that in the world of hard assets, physical reality always wins in the end. I want to hear from you in the comments below. Do you think these margin hikes are just for risk management, or are they a deliberate tool to protect the big banks? And after seeing today's action, do you trust the screen price or the price you pay at your local dealer? Answer those and join the discussion. If you found this forensic breakdown valuable, subscribe and turn on your alerts. The next time